Hello, today I'd like to do a little discussion on understanding insurance policies. This is one of the primary things that you're going to be doing in front of a client. And you need to understand how to look at the policy and to know what you're seeing when you are in front of the client. So we're going to take a little time today to go through what we look for in policies and how we can help a client when we see things that are not necessarily correct on the policy. The policy is a contract, and it's between the insured client and the insurance company. The client is called the insured, and the insurance company is called the insurer. There are four basic parts. We really spend most of our time looking at the declarations component of the policy. The adjusters will be looking at the insurance agreement, the insuring agreement, the conditions and exclusions a little more carefully once a claim has been identified. And the reason for that is that in those pages, the insurance company gives and takes away. So there are things within the policy that may be assumed on our part to be included, but the adjuster will identify as perhaps being excluded based upon these other components of the policy. So the flip chart presentation is really the first step in doing a policy coverage review. I have provided that coverage in a separate video, which you can look at and pick up for yourself. I would either use my presentation or learn how to give the presentation live by yourself. If you're uncomfortable doing it by yourself initially, use my presentation and then you can talk to the policy immediately following that. But the flip chart presentation should be done on every policy review that you encounter. And the reason for that is that the policy flip chart contains a lot of information that the public just doesn't know. They don't understand all of the different perils that are actually covered by the typical policy. And they don't understand why they shouldn't be going directly to their insurance company when they suffer a loss. So doing the presentation prior to looking at the policy is good standard protection on your part to making sure that everything gets covered. So most policies fall into three categories. They're called basic, broad, and special. The special is also known as all peril or all risk. Most insurance companies require that the homeowner carry an all risk policy. That's going to be called like an HO3 policy. It's also known by several other names, and I'll go through those on another page in this presentation. The policies are defined by the kind of coverage that they carry. For example, the most basic of policies is called an HO1 or an HO8. And that is basically a basic policy. It covers 12 or 13 basic categories of perils. The broad then adds on to those basic perils, and then the all risk adds to that any physical damage that is sudden and accidental. So what is a peril? One of the jokes that is often done, or at least it used to be done, is that a peril is not something that you get out of the ocean. It's something that can cause damage or cause loss to real property. By real property, I mean a building, a home, a vessel, a mobile home. All of these things are considered real property. So under the terms and conditions of a policy, the peril, in order for the peril to be covered, it has to be done in a sudden and accidental manner, and it can't be specifically excluded on the policy. In the basic form, these basic coverages cover 10 primary perils: fire or lightning, and oftentimes we separate those out into two separate kinds of perils. Windstorm or hail, again, those are two separate perils often. Explosion, riot or civil commotion, aircraft, vehicles, smoke, vandalism or malicious mischief, theft, and volcanic eruption. We don't really worry about the volcanoes here in the Northeast too much, but we do have high levels of windstorm and hail activity, as well as lightning activity. And lightning activity can be a significant loss, even if the home was not directly hit. The broad form adds to those previous perils, and these also include falling objects. Now, when we talk about a falling object, we're not talking about dropping an iron skillet on the floor. A falling object is something that comes out of the sky and causes a penetration to the dwelling. So we're talking about something falling from an airplane, something falling from the sky, a little bit of a Chicken Little kind of situation. The weight of ice, snow, and sleet is also a peril in the broad form. Accidental discharge of water, that's a huge one that we use a lot at Metro. Accidental tearing apart, cracking, burning, or bulging. I can honestly say I've never done a number 13 claim. I don't know. I believe that part of that claim might be the damage that would be caused by a boiler breaking up, or or perhaps some kind of other mechanical item in the home. But that is a very rare occurrence. Freezing and frozen pipes, etc. Artificial generated electrical current. This is where you have, in your electrical system, you have an arc that occurs, and that arc creates additional electrical energy that then fries an appliance, perhaps causes a burn on the electrical outlet. You'll see sometimes a blackened area above the outlet, which shows that the outlet has been damaged. Volcanic eruption and collapse. Those are additional. And then you have the special form coverage, which is your all risk policy. Any loss that is not excluded is in fact covered. Typical things that are excluded is something called water. Now, water just isn't normal water. Water means floods. It means groundwater swelling. It is not water from the sky. That's rain. That's a separate peril. Another one that's often considered that is excluded is earthquakes. Earthquakes are excluded on most policies. When you're looking at the residential policies, there's these three basic categories of policies. In the A component, which is your dwelling, oftentimes called the dwelling, it actually matches up very well with the kind of policy you have. The other structures, meaning an in-ground pool, a detached garage, those items also follow along with the policy type. But notice contents. When you have a basic or a broad category damage, your contents are covered. But when you have a special damage that occurs, the contents are not covered. So you have to have a named peril with contents, even with a special policy, in order to get the contents covered. Another thing that we look for in our policy is something called RCV, or replacement cost value. Another acronym that we use is ACV, or the actual cash value. That is the depreciated value, the wear and tear that occurs as something ages. You want to make sure that all of the items, the dwelling as well as your contents, are covered on a replacement cost value basis, not on an actual cash value. You will find a lot of times where the contents of a home are calculated on an actual cash value, and that causes a great deficiency for your client. Here's an example. Let's say a chair is damaged in a fire. The chair is 10 years old. but the chair is expected to last for 20 years. So you've got a 50% depreciation of that chair. It's lived half of its life. The replacement value of the chair is $1,000. But now we're going to take away half of its life. So we're going to take away half of the value of that chair, which is $500, which leaves us with $500 that would then go to the client for the compensation of that chair. ACV policies will only pay the ACV. Here's another thing that you have to be aware of, and you have to make sure that the client is aware of. Most RCV policies, where they give you the replacement cost value, pay only at the ACV until the work is completed or an item is purchased. Now, if the RCV is done as an endorsement, oftentimes it's identified in the verbiage in the policy whether or not they'll pay RCV on contents prior to the purchase of the item and the proof that you've purchased. A lot of buildings are paid out at ACV until the invoice comes in from the contractor. So even though the building is on an RCV basis, the contents may only be paid out in ACV unless you have that endorsement. The dwelling policy is for those properties where a tenant is occupying the property. There is no typical contents associated with a dwelling policy. It's for residential properties, typically up to 4 units, and the tenant can be occupying that property. If an owner is on the property, the owner can obtain a homeowner's policy on that property up to 4 units. If it's above that, even though the owner is occupying it, the dwelling policy or commercial policy needs to be in place. So now you look at a much bigger chart here of policies, and I want to try and make this as easy as possible. The easiest way of first looking at this is looking at the notes. A, over here on the side, indicates the building or the dwelling. B represents the other structures. C, contents, and then we're not really talking about loss of use, which is D. ACV is your actual cash value. RCV is the replacement cost value. So they don't show an HO1 policy, but they do show an HO8. Those are basically the same. They're basic policies. Both the dwelling and contents are settled on an actual cash value basis. An HO2 policy, you won't find many HO2 policies. You're going to find mostly HO8 and HO3 policies when you're dealing with a single family home that's detached. When the single family home is attached, oftentimes you'll find it with an HO6 policy, a condo policy. Because oftentimes with a attached townhouse or condo, the association is in charge of the outside structure of the building, and the homeowner is only involved in the interior structure of the building as well as the contents. The HO2 is a broad policy. As I say, I have been here for 4 years, 5 years, and I've never seen an HO2 policy. HO3 is probably, when I'm looking at a detached home, is probably 90% of what I see. You're going to see the HO8 or what's called a forced policy in those instances where the homeowner is in foreclosure or the bank has put a policy in place. The HO3 policy is your primary policy. And as you can see, both the dwelling and the other structures are carried at a special level, which means any damage, physical damage that occurs to the building or to the structure is covered in the policy. Your contents will be only covered on a broad basis, which means they have to have a named peril. So you can't, for example, have the most standard all risk damage that occurs is impact damage. So for example, if we have a floor that gets gouged because we moved furniture, that is in the special category. That's called impact damage, and it's covered as an all risk. Well, if that damage then also breaks a leg of the bed that is being pulled across the floor, or it damages something else, that is not covered in this policy. So that would not be covered by the damage. Only the floor itself would be covered. In order for the bed or the furniture to be covered, it would have to have been damaged based upon an accidental discharge of water, or some kind of electrical current that goes through it, something that would have to damage the interior of the building. That's a named peril that's shown in either the broad or the basic categories. On the HO3 policy, A and B, your dwelling as well as your other structures, are settled on a replacement cost value basis, typically. Now, what you're going to see sometimes is amended kind of replacement value verbiage. And when you see that kind of thing in place, if it doesn't just say replacement cover, replacement cost value, then you may be looking at some kind of modification to it. And you have to be more careful about that and see what that means in the policy. ACV is ACV, and that is your basic, that's the basic way that the insurance company is going to settle contents always, except for on the HO5 policy. On the tenant policy, again, it is a broad policy. It doesn't have a special condition to it. Why? Because most of the special issues are dealing with the dwelling and the other structures, and your tenant policy is basically a contents policy. It's for someone who might be in an apartment. It might be for a college student. There's a number of different cases where you might have an HO4 policy. Notice that there are no options unless you get a special endorsement for replacement cost value on the contents from a loss settlement perspective. An HO5 policy is a high-end policy. You will find HO5 policies typically in larger homes in more affluent communities. Most of the Chubb policies that you'll find out there are HO5 policies. They're called masterpiece policies, and they're extraordinary policies in what they cover. Everything is covered at the high end. Contents are covered on a special basis, as well as your dwelling and your other structures. And everything is settled on a replacement cost value basis. These policies are very expensive. I've seen where a typical HO3 policy might have cost $1,200. I'll see an HO5 or a Chubb Masterpiece policy in the $2,800, $3,000 range. An HO6 policy is a condo or a townhouse policy. Some attached dwellings are actually not part of an association. And if that's the case, then the homeowner actually does have, may have an HO3 policy on that townhouse. I've been in Baltimore and in a couple of other areas where the buildings are attached. However, they are still not part of an association. They're a row house, and those row houses are independent structures, each one of them, even though they're right next to each other. And so the homeowners will have an HO3 policy on them. The HO6 policy is a special policy typically on your A and B, but your B may only be covered on a broad basis, depending upon whether or not it's a townhouse or a condo. These, your contents are always covered on a broad basis. And again, the building is done on an RCV basis. Your contents will be done on an actual cash value. Our forms that are enclosed in the packet that you get to fill out a claim has a loss settlement sheet in it, which clearly defines the different categories of losses in basic, broad, and special. I would highly recommend you take a look at that and identify them and become very clear about what is a broad or a basic coverage. When possible, and when there's any question, try to write a broad or a basic claim. Special claims have special considerations when they come to being adjusted. And so the adjuster is going to be much happier dealing with a broad or a basic claim versus an impact damage. If you have two different claims, one's impact damage, one is leaky toilet, write up the leaky toilet. Other names for the all-risk policy, HO3 we've talked about. DP stands for dwelling policy. MHO3 deluxe policies, special forms. The masterpiece is a word used by Chubb. And then State Farm has to be a little different. They call their HO3 policy a 7955 policy. So if you see 7955 on a State Farm policy, it's an all-risk policy. Your basic dwelling forms are the ones that you're going to find in the field when you're dealing with a commercial building, commercial residential building. So one that is not owner occupied. The basic dwelling form only covers fire, lightning, and internal explosions. And then you have to use the menu to pick out additional perils that you want covered. It's highly recommended that you try to get as many of those as possible because the EC and the VNMM policies are very important, especially the vandalism and malicious mischief on a non-owner occupied dwelling. So when you're in front of the client, the first thing you're going to do is do the flip chart or run through the presentation that I've previously provided you. The next thing you're going to do is you're going to identify the declaration page on the insurance policy. It's usually the first page or it's within the first 5 pages. It depends on how the homeowner has identified and maintained their policy. They may have the first page being a cost page or what's the premium. But if that's the case, then your declarations page may be the 3rd page down. It'll clearly identify itself as a declarations page, and you'll see these 4 items clearly identified: building or dwelling, other structure, contents, sometimes called personal property, and then the loss of use or rents. And that's an important part. We'll talk about that a little bit more later. So you're going to first identify the insurance company. You'll determine whether or not the policy is an HO1, 2, or 3, or an HO8, 2, or 3, or a 4, or 5, or 6 policy. You're going to identify the deductible. The deductible is sometimes listed across the page from where the dwelling and the other structure items are. Sometimes it's in a separate category or a separate box structure, either in front of or behind that, but it's typically on the deck page directly. Then you're going to identify the type of property, whether it's a residential or commercial, the policy type, and you need to evaluate the endorsements after you talk about the dwelling. So here's a policy. This is an older policy. It's based off of a 1991 claim or policy deck page. We have it as Steve McCaffrey here. But the deductible here is $250, which is extremely low for today's deductibles. You're going to find typical deductibles today of anywhere between $500 and $1,000. When you see numbers like 0.5%, what they're doing is they're taking this $120,000 and saying that the deductible is going to be 0.5% of that. So 1% of $120,000 is $1,200. the deductible at this point, if it's 0.5%, would be $600. So if it's a 1% policy, then it'd be a $1,200 deductible. The interesting thing there is that then the deductible becomes a variable. As the policy increases the limits on each of the items, the deductible also increases. And that is not to the betterment of the client. The mortgage company will always be identified on the deck page as well. And you want to take note of that because the mortgage company will need to be identified on the claims packet as well. The coverage dates are always to the same day, 1 year out. So it's not March 30th to March 29th, 2007. That would allow for 1 minute of not coverage. And so in order for it to be complete coverage, it has to be from the one date to the other 1 year in advance. Your dwelling in this case is $120,000. The dwelling should be what the cost is to rebuild the structure, not how much it would cost to buy it, not how much it would cost to sell it, but how much would it cost to rebuild it. That can be oftentimes determined based upon the square feet of the home and the building variable that's used for that zip code or that area. You can Google how much would it cost to build in a particular township, and oftentimes you'll come up with a variable that would be meaningful for your discussion. In New Jersey, typically we're looking at anywhere between about $170 a square foot to about $220, $230 a square foot. That's typical. But again, don't take those numbers. We are not building assessors. We do not do building assessment. Nothing that we say is binding. So please make sure that that your client understands you're providing them a way of understanding what that number should represent, but by no means telling them what they should have. Other structures is 10% typically of the dwelling number. And you can see that's true here. Your other structures includes detached garages, in-ground pools, sheds, other improvements to the property that are not attached to the home. There has to be clear ground between whatever this structure is and the home. In the case of a pool, the cement does not count as an improvement when related to the in-ground pool. An in-ground pool is, by definition, another structure. The above-ground pool is considered personal property. Personal property on an HO3 or an HO5 policy is always going to be at least 50% of what the dwelling is, and it may be as much as 75% of the dwelling. You can see in this case that it's at 50%. The personal property I define to a homeowner as being that property where if you turned the house upside down and shook it, whatever comes loose, that's your personal property. And now what you need to do is understand whether or not that personal property is going to be paid out at actual cash value or at replacement cost value. And this is where I then go through that example. They had the chair a couple of slides back, but those examples are very helpful for making the client understand how important it is that they have a replacement cost value associated with their policy. It's important because most people don't have the money in the bank to cover the difference between the depreciated cost of the property and the replacement cost if they were to go out and buy it. Which means that if they suffer a loss, they are not going to be able to maintain the lifestyle that they had prior to the loss. They will be deficient. The next thing that we talk about is loss of use. Loss of use is normally anywhere between 20 and 30% of the dwelling, and oftentimes is now calculated as actual. It's listed as actual. And what that means is that the insurance company is going to take the receipts that you use in your alternative living expenses, and will pay you back for those receipts. So what is the insurance company liable for in loss of use? Typically, what you want to do is you want this number to be large enough to cover a year of loss of use of their home. Now, what does that entail? That entails a year of rent of like facilities. So, for example, if you have a homeowner who has a 4-bedroom home in Paterson, New Jersey, then the insurance company needs to be able to pay the rent of a 4-bedroom home in Paterson, New Jersey for up to a year. If you live in Alpine, New Jersey, and you have a 6-bedroom mansion up there, it's the insurance company's responsibility to put you in like facilities for the duration of the time that you are out of your home, which is typically considered a year. I will see on some Allstate and State Farm policies 2 years, but then they're very limited in what the numbers look like, and so they're really playing a game with the client. Loss of use, one of the things I look for, and this is just me and what I look for, I want that loss of use to be twice as large as the cost of renting a home for a year that is like what they live in. So, for example, if their home, to rent a home like theirs for a year is going to be $5,000 a month, then I want to see not $60,000 in the loss of use. I want to see $120,000 in that loss of use, because that will help cover some of the other expenses that come into play when you aren't able to use your home. And we can go over some of those. So a good rule of thumb is for that loss of use to be twice as large as the cost of renting a home like what you're sitting in when you're doing your policy review with your client. And I would have them tell you how much a house is going to cost to rent. Don't put the words in their mouth. Let them tell you what it's going to be. But as long as that loss of use, the rent of a home is less than half of your limit, you're probably in good shape. We don't really talk too much about personal liability or medical payments to others because we don't do any adjusting on those items. Section 2 is beyond our purview as far as our licensing. Personal liability, in rough terms, means your liability when something happens on your property. And medical payments is helping someone get to the hospital, taking care of any medical issue that arises because of something that happens on your property. You'll also see in this declarations page what year the house was built, what fire district it's in, identifying its location to a hydrant and the fire department. You won't find that on every policy. The companies have different standards as to what's included on the deck page. You will note on this one that the endorsements are only in a numbered format. In most policies that we review, we will find the endorsements actually spelled out a lot more clearly. I have never really spent too much time with the codes, but when you see an HO and an 03, you know you're dealing with a special policy. You're dealing with an all-risk policy. This indicates when the policy was last edited and modified and agreed to by the state. I always ask the homeowner if they've got a sump pump. If they do, they need to have a sump pump endorsement. The endorsement is typically going to be for $5,000 to $10,000. What that means is that the insurance company is going to be limited to $5,000 or $10,000 of damage should the sump pump back up. Another thing that you want to look at in your endorsements is the scheduled jewelry. Now, it may not be jewelry. You also want to ask about furs. You want to ask about collectibles. I always talk about whether or not somebody's got a baseball card collection, because that seems like an innocuous kind of collection, but some of those cards are pretty valuable, and people that know about those cards know that. Anytime you have a collection of things, you need to really worry about whether or not those collectibles are being covered on the policy. The other thing that you'll find is the hurricane and wind deductibles. If wind is included in a higher deductible, I always tell the client that that's not a good thing. That a hurricane deductible being 1% or 2% of the policy is not an unusual thing. But having wind included in that really constrains their ability to use their policy should they lose some siding or some shingles in a windstorm. Home-based business, if they have inventory, Avon or Amway or something else, and they've got things that are in the house, oftentimes those things are not covered by the homeowner's policy, and they need an endorsement for home-based business in order to have those business products and that business property covered on their home property. Replacement cost on personal property, we've talked about that. That's an endorsement that I really look at as a mandatory endorsement. Collectibles, again, make sure that you ask the question as to whether or not they've got baseball cards, or I had a client that had pool cues. I had another one that had crystal, hundreds of thousands of dollars of crystal in their home, and they did not have a collectibles endorsement on that crystal. So the crystal was basically covered at $1,500 or $2,500 for the whole collection. It's terrible, but that's the way the insurance company is going to pay it out if you don't take care of these things. The other endorsement that's not included on this page and is actually included on an exclusions page later on, but it's typically comes up under the endorsements, is ordinances and law, or codes and ordinances. What that is that's a 10% coverage for any codes that may have changed from when the building was built to when the damage occurs, that are required to be made in order for the building to be rebuilt. So if you have to upgrade your wires because of an insured loss, this coverage allows you to increase your home to those levels without having to have it come out of your pocket. It would normally be your responsibility, but that can be a significant cost. And to add this oftentimes to a policy is less than $100. It's oftentimes around $50 to add it per year, and it can save you thousands and thousands of dollars. Once the policy has been reviewed, oftentimes the client will tell you about something that's been that they had happen in the house or in the business. I was at a client yesterday where they had a secondary hot water heater that had broken down. There was nothing sudden and accidental about it. It was just pure wear and tear. So it wasn't covered by there was no damage that ensued from it either. So there was nothing there that was of an insurable loss. You always want to ask, was it sudden? Was it accidental? Did you see that water stain on the ceiling on Tuesday, last Tuesday? That's a sudden and accidental event. Is it within the statute of limitations on the policy? I actually want to see, when possible, that the damage occurred within the last couple of months, especially if it's an impact damage or a special policy condition. The insurance company really pushes back hard on things that are 9 months to a year old when it's on the special form. If it's a broad or a basic policy, sometimes they're not as tough when it's out 6 months to 9 months. But you want to get that done as quickly as possible, because it is the insured's responsibility to, on a timely basis, notify the insurance company of a loss. General exclusions, I told you this was going to be there. Ordinance or law is typically excluded. And the key on this is that that's why you need to have it as an endorsement, because otherwise it is excluded. And that can mean thousands of dollars to the homeowner in extra fees and extra expenses. Earth movement or earthquake is not covered. Water, and it's interesting that they use that term because oftentimes when you have a water event that occurs in a home, it's actually an accidental discharge of water. It's not a water event. So the insurance companies will use our misunderstanding of their terms against us. And so it's important for us to make sure we're using the correct terms. So when you have water that gets discharged, it's an accidental discharge of water or an ADW. It's not water, because when the insurance company hears water, they're thinking flood or groundwater. An off-premises power failure is not covered on most policies, which means you have an electrical generator or something blow on the power line and causes your house to not have power. Any damage that occurs because of that power failure is not covered. Ensuing damages that are a result of it within the house, like an accidental discharge of water because the refrigerator was not properly powered, would be covered. But any damage that caused because of the power failure itself would not be. Active wars and nuclear hazards are not covered. Neglect is not covered, but it's a very high standard there that needs to be dealt with. An intentional loss is not covered. If you punch the wall with the intention of breaking the wall, it is not a claim. And then government actions are not a peril in your typical insurance policy. Policy conditions require that the insured do certain things. One of them is to give prompt notice. And that is subject to interpretation as to what prompt means. But at Metro, we don't deal with losses that are over a year old, typically because that is not dealing with prompt notice. And oftentimes, certain damage will not be insurable either, and it'll end up being wear and tear because prompt notice was not given. Protecting the property, this is called mitigation, meaning that you are making sure that the property doesn't sustain further damage because of damage that has already occurred. To make reasonable and necessary repairs. This is dealing directly with that above line. In other words, it's important that you protect the property and that you make repairs that are necessary so that additional damage doesn't occur. Protecting the property can also mean putting a fence around a fire damaged building, or putting plywood over the windows of a fire damaged building. All of those are things that you're doing to protect the property from further damage. Further damage can mean liability as well as physical damage. It is the insured's responsibility to prepare an inventory of damaged property, meaning primarily of personal property or contents. We take that on oftentimes for the insured simply because they don't have the ability to do it on their own. To show the damaged property as often as necessary, the insurance company may require multiple visits to the property, and it is their right to do that. To provide the insurance company with records and receipts as requested. Whenever we provide a contents list or we have a contractor that has worked on a property, we always need to be able to provide the receipt to identify that work as having been done. And then it also, to submit to the company within the state's guidelines after requested, a proof of loss. And oftentimes we will produce that and have the client sign it. The loss settlement is the condition under which how a claim is going to be adjusted. And that's a whole section of your policy. Under the basic residential form, personal property and dwelling losses are done at an actual cash value with no coinsurance requirement. Coinsurance means, on a really basic level, that the house is insured for what it will cost to repair it. Coinsurance requires that that house be insured at no less than 80% of the actual cost to rebuild that house. It is the insurance, it's the client's responsibility to make sure that the number is correct. It is not the insurance company's responsibility. Under broad and special residential forms, personal property, awnings, carpeting, that means wall-to-wall carpeting, appliances and stuff, which is not buildings, are adjusted on an actual cash value basis. The dwelling itself, however, may be done on a replacement cost basis. So I'm hoping that this has been of benefit to you. It gives a little bit more indication as to what you need to be looking for when you're looking at the policies, and gives you a little bit of a basis on which you can look at a policy and start being able to describe it and talk with it with a client. We'll have some more training on this later, but I hope this has been helpful. I'll talk to you later. Bye-bye.